In this video, we'll explore the world of ETFs and index funds, specifically focusing on how they deal with market volatility and adapt to changes in the market, such as company failures. Let's dive into the agenda. We'll start with an introduction to ETFs and index funds, then examine their mechanics. Next, we'll discuss index rebalancing, explore risk mitigation strategies, and finally consider a long-term investment approach. Exchange-traded funds and index funds are financial vehicles that track specific market indexes. This includes major indices like the S&P 500, offering diversified investment opportunities to both new and seasoned investors. ETFs and index funds work by aiming to mirror the composition of their underlying index. Fund managers make necessary adjustments to the fund's holdings depending on the performance of companies within the index. In case a company goes bankrupt or does not perform well, it is removed from the holdings and may be replaced by a new one that has joined the index or increased in market capitalization. Rebalancing is a critical aspect of managing index funds and ETFs. Major indexes such as the S&P 500 undergo regular rebalancing to ensure they reflect the performance of top-performing stocks. Consequently, the ETFs and index funds tracking these indexes automatically adjust their holdings to align with the changes. This process is crucial in maintaining a precise representation of large, publicly traded companies. Let's see how much you've learned. What happens to a company in an exchange-traded fund if it goes bankrupt? Is it A. It remains in the fund. B. It is sold off and replaced. C. No changes are made. Or D. The ETF ends? You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. It is sold off and replaced. When a company in an ETF goes bankrupt, fund managers sell its shares and replace them with shares from new companies that have joined the index or increased in market capitalization. Although ETFs and index funds provide diversification, they come with some level of risk, similar to any other kind of security. Diversification helps mitigate this risk to a certain extent, especially in comparison to investing in individual stocks. But investors should still be aware of the inherent risks. A long-term investment approach is often recommended for those investing in ETFs and index funds. Market fluctuations are expected, and maintaining a long-term outlook usually yields better returns than stressing over short-term volatility. Instead of trying to time the market, focusing on spending time in the market can help meet long-term financial objectives. Investing in ETFs and index funds can provide a strategic gateway to joining the stock market. Understanding how these funds regularly adapt through strategies like removing underperforming stocks and adding new ones is essential. Remember that all investments carry some level of risk, but adopting a long-term perspective often maximizes returns. Thank you for joining us and exploring how ETFs and index funds handle market volatility. If you found this video helpful, please like and subscribe to our channel. We would love to hear your thoughts and experiences, so feel free to leave your comments below. Until next time.